I think we are pretty much here. Kelly, did you want to start with an intro and then I'll
Sure,
take over?
I can do that. So, everybody, I wanted to get Craig to do a class for all of us on assumptions because I feel like this is a really good direction for us to head if interest rates stay high and people find themselves unable to buy. We have such a large VA pool in this area with the military and the government being here. And I feel that if we're all well trained on assumptions, we can help not only our sellers, uh, but buyers, because we might be more educated on something than agents from another company who don't have this training. I did an assumption last year and I did it by myself, and it was not that easy. So finding a company that can help us, not only train us and educate us on what to say, but do the background stuff like we used to have in the old days with short sales. None of us really negotiated a short sale by ourselves. We all had people help us. And that's what Craig's company does. And I think that this would be not only a good education for us, but if you're sitting in front of a seller and you know that they have a VA loan, we might be able to pick up more listings because we can speak to how an assumption works, whereas our competition, might not know how any of this can happen for them. So with that, Craig, thank you very much for being with us today.
Thanks for having me. It's a pleasure to be here, and we love presenting this information. To be respectful of everybody's time, I'm going to jump right in, and we'll have a Q&A session at the end. So, if questions come up, just make a note of them, and we will try to address as many as possible. And so, we'll dive right in here. Okay, so hopefully everyone can see my screen. Give me a thumbs up if you can. I am Craig O'Boyle. Excuse me. I am the owner of Assumption Solutions, and we started our company here in 2022 when things started to make a change, and it has grown to be quite the little juggernaut. We're seeing quite a bit of activity in this market. So, without further ado, let's jump right in. All right. In the interest of being not too dry, I have a little humor. So, interest rates when bottoming out is a good thing. So, I took this photo in a Home Depot parking lot. How low are interest rates on assumptions? Well, in some cases, as low as this truck. Believe it or not, the lowest rate we have seen done is 1.75%. All right, here, let me admit a few others showing up. All right. All right, so our agenda today is we will do a mortgage loan assumption overview. We'll talk about assumable loan types and eligibility, the value of a loan assumption, assumption process steps we take you through, pricing we charge to help you get through an assumption. And then I will put on, we'll talk about the evolving market, and then I will change gears a little bit, and I will put on my 30-year real estate agent hat because, like many of you, I am a realtor as well. And I'll talk about closing more deals. So, how to grow your business in the assumption space, something I think every real estate agent would love to learn more about at any given time, how to get more clients. All right. So a mortgage loan assumption occurs when a buyer agrees to take over the existing loan of a seller, becoming responsible for its repayment. There are two types of assumable mortgages, qualifying and non-qualifying, but non-qualifying assumable mortgages are pretty much rare to non-existent. They sort of existed back in the late 80s, maybe a few in the early 90s, When I first got licensed in 1995, we would occasionally see one of those come around, and we would sort of just run out the door and try to buy them ourselves because you basically just had to say you wanted to take it over. But the government entities got rid of those, and now they are all qualifying, and they require the buyer meet the same qualification standards as the original borrower. All right. Still admitting a few showing up here. Um, all right. A mortgage loan assumption occurs when a buyer agrees to take over the existing loan of a seller, becoming responsible for its repayment. Oh, I'm sorry. I think I already did this slide. Let's skip ahead to this next one. Now, nearly all qualifying assumable mortgage loans today are FHA and VA guaranteed loans. I will, as an aside, mention that conventional loans, while not traditionally assumable, we do see that occasionally you can do them in the case of divorce, where there has been a court order or something in the divorce decree that allows that to happen. VA loans can be assumed by both veterans and non-veterans. However, only when the assumption is made by another veteran with sufficient VA entitlement will the original borrower's entitlement be released from the loan by substituting the new buyer's entitlement. So this is something that a lot of people don't know. They think it's only veteran to veteran assumptions that can take place, but that is not the case. It can go to non-veterans, but there is sort of a consequence to the seller. Now, they're always released from liability in the assumption, meaning they're no longer responsible for the loan. But entitlement, I always say entitlements, think of it like a dollar amount that they have earned through serving our nation to be able to get that VA loan. And so if it goes veteran to non-veteran, the entitlement is either eliminated because they've used it all on that loan, or it's reduced by what was used to get that loan. So in some cases, they may still be able to get a VA loan, but they won't have the entire amount of their entitlement remaining. They'll only have what is left. Um, we see in what we process, maybe 3 out of 10 of the loans that we are involved with go veteran to non-veteran. I encourage real estate agents to not prejudge what a seller is open to doing. You never know. The situations where we commonly see it go to non-veterans is someone may be elderly and not going to need that entitlement again. We've seen many situations where there's two spouses with entitlement and they're okay leaving one and using the other the next time. We've seen all kinds of different situations, but sometimes it's also whatever the heck gets the house sold. They just need to move on and get that house sold. So don't prejudge what someone is willing to do. Just make sure you let them know what those options are. We do get a lot of questions about how does entitlement release down the road. That entitlement is tied up until this loan is paid off. So it could be if someone's taken over a really low rate loan, it could be, 27 years down the road. So it could be quite a long time. It could be 5 years down the road. Nobody knows exactly how long, but I know that a lot of people that are taking over these loans have a plan to keep them for the long haul because it's very unlikely that we're ever going back to 1%, 2% rates. So keep that in mind. Now, FHA loans are also assumable, but they don't involve any type of entitlement issues like VA loans. They do require mortgage insurance is paid on a FHA loan with every payment for the life of the loan. So that was changed maybe 10, 12 years ago, I think now. So as part of your payment, you do have mortgage insurance versus a VA loan where mortgage insurance is paid in an upfront premium. So keep that in mind. Now, both VA and FHA loan programs are primarily intended for owner-occupant purchasers, but there are some things I will address that have evolved in this market since we have been involved in it. Okay, let's go to the next slide. All right, now I'm going to nerd out a little bit on numbers here. This is my actually favorite slide to go over. I think this is what really attracts people to this market space. And it's crucial for you to master this stuff for informing potential clients, marketing potential listings, and so you can show people the true value of this market space. So we have four columns here, and the first one we're going to talk about is a payment comparison, right? We're going to look at a $400,000 loan at 7% interest, which is equal to a monthly payment of $26.61 versus a $400,000 loan at 2.75% interest, which is equal to a monthly payment of $16.33, which is a monthly savings of $1,028 or an annual savings of $12,336. Now, obviously, interest rates are fluctuating at current, probably in the sixes. So these numbers are not necessarily exactly what you're seeing in today's marketplace, but it's pretty close still. So when you talk to potential buyers, this I call the headline number that really gets them interested in diving in and going to buy a house. I mean, if you can save $1,000 a month potentially in your mortgage payment, it's very, very attractive. So the next column talks about what we have all felt since 2022 when rates changed, and that is the reduction in purchasing power. So that monthly payment of 1633 is equal to a $400,000 loan at 275, obviously, or a 245 $500 loan at 7%, which is a decrease in purchasing power of 154.5 to keep that same low monthly payment, right? That's meaning the purchasing power is reduced to 61.4% of its previous level. This is the affordability crunch that we have all felt for the last few years. And it's tough. I think it has been tough in this marketplace to just get buyers to commit and to get off the dime because they feel this more than anybody else. So if you can show them in an assumption these kinds of numbers and what they can save over time, they'll really move. Now, the next one here that I'm going to talk about, interest saved over time. This is where the really financially savvy people come into play because this talks about the amortization schedule and where wealth is really built. This is the one that I love the most. So when you look at this, total interest paid on a $400,000 loan over 30 years is $558,036 at 7%, or $187,868 at 2.75%. That's just interest. So the total interest saved over 30 years is $370,000 and change. That is massive savings. This is where you really build wealth over time. Now, we're going to do a little exercise and pretend that this low rate loan comes on the market to be assumed and what it looks like. So let's say it's been 3 years old, 3 years old loan, was it originated 3 years prior? The seller of that home has paid interest for the first 3 years, and they have paid just under $32,000 in interest up front. So what that means is when the buyer comes along and assumes that mortgage, right, their interest savings is 402,106, which exceeds the original balance by $2,106. That is absolutely mind-blowing that you can save that much in interest just by taking over the loan, which is another reason that I think people who do these purchases and assume these loans are likely to keep them for the long haul rather than pay these loans off or get rid of them. So if you have a veteran who goes and does the assumption with a non-veteran, they probably need to anticipate that that entitlement is going to be tied up for the remainder of that life of that loan. Okay, the last column here I'm going to talk about was something we never thought about when we started this company until we actually processed this very deal. And this was older loans with higher interest. So we had a deal we processed early on when we started this company, and it was a $500,000 loan had been originated at 5.29% in 2009 with a payment of 2773. Now, obviously, 5.29% wasn't that much below current rates at the time. So maybe it didn't seem as attractive, but the truth was that it's gone 15 years into its term. So the remaining loan balance 15 years later in 2023 at the time was 358,759. That was the remaining principal. Now, of course, because it was an older loan and markets have gone up quite a bit, there had been a lot of appreciation in the property. So when it came on the market, the list price was 900,000. So there was an assumption gap between the price and that principal balance of 358 of over $500,000, 541, 241. Now, the potential buyer of this home had sold a home, had that gap in cash, really could have financed a new loan very easily, but wanted to do the assumption because of the savings in interest over time, because the interest paid by the seller over that first 15 years was 336, 421. That had already been paid out through the amortization schedule. So the remaining interest over the final 15-year term was only $164,000 in interest to be paid. So when you understand that not only in an assumption might you be assuming a lower rate, you're assuming the remaining term with the remaining interest, this market gets even more attractive to potential clients because you're anytime you're not paying interest, you might as well be making it. That's my philosophy. So lots and lots of potential deals, even if it's not the lowest interest rate out there. Something to keep in mind. Okay, hopefully nobody's getting too glassy-eyed with my numbers. We're going to move on to some of the assumption process steps and what things look like in this marketplace when you're looking to do a deal from either the list side or the buyer agent side and the process we take you to. So in either case, buyer or seller, one of the first things you want to do is confirm the property has an assumable FHA or VA loan. So review the existing loan documents carefully. All parties should pay close attention to the loan amount, interest rate, and payment terms. Those are the asset you're either marketing for sale or purchasing as a buyer. So that stuff is crucial to know, and you do not want to hide it from anybody. It's not confidential type information that you want to hide. You want to get that out there as much as possible. Okay. You can obtain an ownership and encumbrance report from a title company to confirm that the loan indeed is, and they all are FHA or VA. If it's conventional, it does not carry that assumable clause. All right. Next, you're going to execute an assumable purchase contract. Now, we are based in the state of Colorado, and I can talk deeply about the Colorado contract, but if you're not in Colorado, you want to review your own contract and make sure you understand if your contract has specific sections for assumptions. Most that we have seen do, but it's a state by state thing, of course. Now, when you create that contract, it's important to know timelines. Servicer assumption approval takes 45 to 120 plus days, averaging 60 to 90 days. Some deals are as fast as 45, and we have seen some as fast as 30 to 60 days. But call us to check your servicer because we track every deal we do and we can look at a servicer and say, what are they trending at? What has their timeline been for the last 2 or 3 deals we have done with them? I will say the major things that affect the timeline are number one, their internal systems, which when we started did not exist. Truthfully, when we started, we were dealing with a lot of servicers who didn't even realize they had to do these, right? And they were trying to tell people we're just not going to do them. And we had to get the VA involved, the FHA involved, because this is a guaranteed benefit of these loan programs. So now they've all started to get much better systems and they started to get a lot quicker in their timeline. But then what started to happen was as the word on this marketplace started to spread, we started to see volume become the biggest issue. And especially this year, volume has grown tremendously. And so with high volume, they just get backed up. And so even servicers that started trending in, let's say 30, 45 or sub 60, they started getting so many more deals into the pipeline that they started to back up. So I consistently tell agents that when you're planning on doing a deal and you put it together and even when you check with us, I think you need to give yourself as much time as possible. I would say the minimum you should give yourself is 60 days to get loan transfer approval from that servicer. That's not your closing date. Loan transfer approval just means all the conditions have been satisfied. They've given it the thumbs up. It will then move to the closing department. But getting through the closing department usually is maybe a week, something like that. So, all right. Now, the buyer needs a plan for the gap between the purchase price and the loan amount. Usually, it's a cash down payment, but I'm going to address this in a further slide. There are options other than that. But usually, still, what we are seeing is the majority of people doing an assumption are covering that gap in cash. Flexibility, advanced planning are essential as the process may take time. The thing that we see frustrate people the most from agents to clients is the difference in this process. You know, when you write a normal purchase contract with a new loan or cash deal, you have hard deadlines that usually are met. Now, do not need to adjust. In an assumption, even if we tell you that we've seen the servicer consistently taking, I don't know, 60 days, that doesn't mean you won't get done in 65 or 70 or 45. With any average, some are longer, some are shorter. So keep that in mind. All right. Now, what we hope you do next, right when you go under contract, where we get involved, is you send the contract to us at Assumption Solutions. We function as your assumption transaction coordinator. Assumption Solutions will vet your transaction to determine if we can help you be successful rather than you waiting for weeks or months for servicers to review your submission. On average, servicers don't even look at your submission for 2 to 4 weeks. That is a very long time. I do not want to be in a deal as a real estate agent, either for the seller side or the buyer, not knowing if it's likely to work for 2 to 4 weeks minimum, right? Our team will look at your file. That's what we're doing up front. Step one for us is vetting your transaction because our team doesn't want to touch the file any longer than you want to be in it if it's not likely to work. So usually within a day or two, we're able to turn around and say, yes, this should be approved by the servicer, right? As long as the clients get us what we request in a very timely manner, you usually are going to have a thumbs up from us very quickly or a thumbs down. Sometimes a thumbs down very quickly is very valuable as well to everybody involved. So you can go and move on to the next transaction. Once we have vetted it, we'll then help you navigate submission to the servicer. Ensuring it's done right the first time, as errors will lengthen your timeline. If you submit incorrectly or missing things, and then they get it and they reject the submission because something is in error, you then have to turn around and resubmit. And what happens is you're actually going to the back of the line again. So you've got to then wait for them to get to your new submission again, and you're abnormally lengthening your timeline. You're doing an unforced error, which will make your deal that much longer to get to closing. All right, now ultimately, the servicers is issue assumption approval on your transaction. We will, once it's in, we will then continuously and regularly follow up with the servicer to ensure they're moving the file forward. We'll help you understand the process at each stage and adapt as needed. Our role once it goes into submission is try and light a fire under them, consistently keep and move it forward, catch any errors that they may make, which they do frequently make errors. We have seen many times where they miscalculate income. Now, keep in mind, the servicer, this is more of a pain in their butt than it's not a revenue generator. So if the deal falls apart, it's really not a negative for the servicer at all, right? If matter of fact, if the loan completely went away, think about it. They get to get this money back that they can then lend out at a higher interest rate. So there's not a lot of major motivation inside the servicers to see these deals go smoothly, easily, and get to the finish line, right? Now, they're obligated by servicing VA and FHA loans to do this. It's a benefit. But at the same time, for benefits to usually be honored, there needs to be some kind of motivation or something positive behind it. But there just isn't in this case, which is why we think we bring a lot of value to helping you get through the process. All right. Now, the servicer takes in and processes the assumption application. Once they grant assumption approval and clear to close, closing can then be scheduled. Timelines may vary, so remain flexible. Remain flexible. I'll say it over and over and again. I say it every day to probably 10 people. It is a flexible timeline. Okay. All right. Now we'll get into another little thing that hopefully makes you chuckle. If it doesn't, I'm sorry. It's my sense of humor. Um, Navigate a complex process with experts. Teamwork makes the dream work. So in this little meme, we've got real estate buyers before and after. And if you look from top left on down, you've got three groups that didn't use you as their real estate agent. But then you've got the bottom right fella who used you and got their dream home. Well, we like to say we're trying to keep you from looking like any of these poor people by going through an assumption without us, because we know a lot of agents that pull out their hair through this process, and we try to make it as easy as possible. Okay, enough with my goofy meme. Now, obviously, as a company, what we do, we charge a fee, right? Assumption Solutions charges each party a $950 fee, totaling a $1,900 fee per transaction. The first $50 is due at engagement from each party, with the remainder payable only if the servicer issues assumption approval. So our goal here is to be low cost, low risk, high value. So all they're risking up front with us is $50 per side to have us take it all the way through. If it doesn't make it to the end, whether I don't know, something strange happens, like it falls out from inspection or title or whatever, all they have paid us is the first $50 up front. If we get to the end and get to clear to close, then we bill out our remaining 900 per side. So seller success fee 950, buyer success fee 950. Now the servicer slash government assumption costs, there is processing fees from the servicers. They're often under $1,500. There are some servicers who actually collect their fee in advance. It's something that is servicer specific, right? But it's generally pretty low cost. Now with the VA, there is a funding fee of 0.5% paid by the buyer, right? That's much lower, however, than when you get a new VA loan. It's only 0.5% unless the buyer has a qualified VA disability, which waives that funding fee. But in most new loans, that funding fee is financed in as part of the purchase. So often when you see a new VA loan, the loan amount is actually higher than the purchase price. That's not the case here. In an assumption, the loan never changes, right? So they'll be paying that in cash at closing. But the cost to do an assumption in most cases is actually quite a bit less than the cost of new financing. You don't have a lot of the normal new lender charges involved in your purchase. You also don't have to do an appraisal when you're doing an assumption because that loan, there's nothing changing with that loan. That loan had an appraisal when it was created, right? So your borrowers often have significantly reduced costs in doing an assumption. On the seller side, there's really not a lot of difference at all. The only differences, which I'll talk about in a little bit, might be how some things go with the prorations of some of the escrow accounts, but I'll talk about that as we go forward. Just a little example of the pricing structure, right? Buyer and seller splitting the fee, $950 per side, upfront engagement, $50 each. Assumption approval and clear to close is issued. The remaining $900 per side is invoiced. Now we bill outside of closing. We don't bill at closing. We bill directly to the clients via Square. So keep that in mind. The reason we do that, we thought we'd do it a different way up front, but what we found was it actually created issues with some servicers because once it got to the closing departments never deal with us as a company. And so when they were trying to do the figures and there was this assumption fee showing up on the settlement statement, they thought their company was trying to charge it and it was creating delays with closings. So we went away from that model several years ago. We bill directly to clients outside of closing. Now, our fee commonly is split, but it does not have to be. It's subject to whatever you negotiate in your transaction. But it can be paid by one party or third parties. The most common non-split scenario we see is actually the buyer ends up paying our fee because the buyer gets probably the greatest amount of benefit from an assumption other than that what helps the seller just get the home sold if it's having difficulty selling, or maybe even helps them get more money because the buyer saves so much in the assumption. So in that case, the total success fee of $1,900, $950 per side. The upfront engagement fee would be $100 to one party, and the $1,800 would be invoiced to one party outside of closing via Square. Okay. Once again, in either scenario, if assumption approval is not achieved, the only fee collected is the $50 engagement fee per side upfront. It's low cost, low risk, high value. All right, now we're going to talk about the evolving market. This is things that we have seen change since we started in this space in early 22. And this space, I continually tell people, is kind of like the Wild West of real estate. There's always new things going on. And I love always doing these classes because I oftentimes have some little nuance to add just week to week. So, occupancy requirements. When we started this process, nobody but owner occupants could do assumptions. Then it started kind of coming out through conversations between us servicers and the VA that, well, why does it only have to be owner occupants? And so the VA can now go veteran to investor. But if it goes veteran to investor, the entitlement of the seller, just like veteran to non-veteran, must remain attached to the loan. But investors can purchase VA loans through assumption. That is not the case with FHA. FHA loans can only go to owner occupants. So we have seen a lot of growth in this space with investors. We've seen investors purchase multiples, but there are things that are specific that may eliminate some investors. Number one is that the investor must purchase the property in their name because they're going to qualify for that assumption individually as a person. not as an entity. So you must do it in your name. Now, I get all kinds of questions. Well, can we move it out of our name after the fact and stuff like that? All I'm going to say is, anytime you change vested ownership, does that give the potential for the loan to be called? Technically, you're not supposed to change the ownership name in any loan. So I'm going to say you probably shouldn't, but is that happening? Maybe. I don't know. So, all right. The potential for obtaining secondary financing. This, I think, has been the most commonly asked question we get. That gap, which many gaps on average that we see are at least $50,000 to $75,000. The largest gap on any deal we've processed was $1 million on a $2 million sale. So obviously, having cash resources is not something every buyer is capable of meeting. And so we have steadily seen a march toward companies looking to find a way to grow their loan business and create products. What we have consistently seen now for secondary financing is there are purchase companies that offer what is called a purchase money HELOC. So it's a line of credit on the new residence that is there to cover some of the gap. Generally, we have seen that the max that they will do when you combine the first and the second together is 90 to 90% of the purchase price. Commonly 90%, meaning 10% of the purchase price would still need to be put down in cash. Now, there may be other programs out there. We don't offer any secondary financing at all in our company. I'm just telling you what we have seen. So, what that would mean, for example, let's say there is a $500,000 sale price, a $400,000 loan that could be assumed. 10% down would be 50,000. That means you could get another second for 50,000 and you would assume that first at 400,000. But things to keep in mind with a purchase money HELOC, they're usually adjustable and their rate is set by the Fed prime rate plus a spread. So likely your rate is going to be somewhere, I'm guesstimating 8 to 10% on those. So with a higher second and a lower first, when you qualifying for the assumption, you got to qualify on the blended rate between the two. Now, if your second is too big, like equal to, let's say, your first, well, when you do the math, you might not actually be making much in terms of savings. It might make sense to just get a new loan. But when your second is significantly smaller than your first that you're assuming, you're still probably going to generate quite a bit of savings in the process by doing the assumption. So anyway, we have seen this start to grow. We do know people that are doing in this space that I'm happy to, if you reach out to us through our website or an email, I'm happy to connect you with some of the people we know. But you may also want to check with people in your own marketplace and say, hey, do you have a product for this? Because it just it just makes that many more people who can potentially purchase a property through an assumption. All right. The 45-day rule. So this is where, let's say you're doing a VA assumption and it's veteran to veteran, and the veteran purchasing the property has sufficient entitlement to do a swap. And I didn't touch on this earlier. I should probably say this. When I say sufficient entitlement, that means they have exactly or greater the amount of entitlement needed. In a new VA loan, if a veteran is short on entitlement, they can generally put down a little extra cash and get bonus entitlement. If you're short on entitlement by $100, you cannot do a swap. So that is something that's very important to know. And obviously, that is something we at Assumption Solutions are checking up front. But let's say you are doing a swap. So the key to the swap is it takes place post closing, right? And so what that means for a seller is it can mean that their timeline to be able to complete that next VA loan is going to take some time to get approved. So in a new loan scenario, we're all familiar with the fact that you can sell a house and an hour later go down the hall and buy a new one with a VA loan. The way that the regulations work, which I hope change because it's antiquated, are that once the swap takes place, the servicer has uh, 45 days to notify the VA that a swap has taken place. Now, the VA has the timeline also to to reinstate that entitlement, but we're finding that the VA has actually been pretty quick with that. But they technically have another 30 days to do it. But generally, what that means is you're not going to go from selling the house via assumption to getting your new VA loan the next day. So you need to keep in mind that there could be a gap of time in there before they can complete that new purchase. So we think that should change. It shouldn't take that long, but once again, it's an antiquated rule. The last thing I'm going to talk about here, handling of escrow accounts. So it's not as clean as we would all like it. My main advice here, or main comment that I'm going to give, is that the handling of escrow accounts is really going to be driven by the requirements of the servicer, right? When when you're doing the assumption, every loan is going to have a difference into when it was created and when certain things were paid out of the escrow account. Now, taxes are a little bit more predictable, but things like insurance aren't necessarily as predictable because it's more the anniversary of when the loan was created. So if insurance was just paid out, there might be a deficiency in the escrow account. Now that insurance policy is going to go away for the seller. You're not taking over their insurance policy. The buyer is going to be getting a new insurance policy, which also means that their loan might change, right? Their loan payment might change, right? If the insurance is higher, which I don't know any market that insurance doesn't seem to be going up in, there could be a change. So, um, how things are going to be dispersed, whether there's going to be, you know, some money added into the escrow account or whether the full refund is going to go to the seller, at the end of the day, it's going to be at the discretion of the servicer. And what they say goes is kind of what you're going to have to follow. So I don't want to dive too much into that because it depends. That's how I'll say it. It really just depends. Okay. Uh, VA eligibility, looks like I've actually doubled up on this between the two. So we'll go ahead and skip that because I've already talked about the restoration timeline. Okay. Now I'm going to switch. Okay. We've talked about the assumption process and what you're going through. I'm going to put on my real estate agent hat and I'm going to talk about closing more deals, right? And so we'll have another little meme here as we start this new section. They said it would be easy getting into real estate, right? Well, being in real estate, being a real estate agent is the least stressful career I've ever had, said Jessica, who's 29 years old. She obviously looks like she's not stressed out at all. All right. Once again, hope you get a little chuckle. Okay, now closing more deals. So the goal of a real estate agent is to guide their clients to be successful, um, whether selling or buying, right? And we leverage all the tools as agents to help our clients achieve this goal. So as an agent, what I want to discuss here with you is, how to market to potential sellers with assumable mortgages to secure more listings, how to target buyers who could benefit from assuming a lower rate loan, how to effectively promote listings with assumable mortgages. A lot of people have a great asset to sell, but they don't expose it properly to the marketplace. So I think that is key to getting you increased sales. And actually, if you have buyers, to finding these properties. So I really like to talk about that. And then I'll talk about with some of the other experts that are in this space to maybe help you in your journey with assumptions. Okay. So, market to potential sellers with assumable mortgages to secure more listings. Some things that you can do here. So, reach out to your past clients or your network with assumable loans. Highlight the value of assumable mortgages in a rising interest rate market. They are valuable, right? If you can demonstrate to buyers that you have a listing that can save them thousands and thousands of dollars, that makes, in my mind, that listing more attractive than anything else in its neighborhood. And so if you could look at your past clients and say, hey, who did I help in the past that bought VA or FHA? You can go to them and say, hey, did you know that when you bought this house, you got a special asset that you can market if you ever want to sell? I know you may not want to sell. You may want to keep this asset forever, but just so you know, you have something unique. So start with your past clients. I think that's always the best place to start. Now, use social media to educate homeowners on assumable mortgages. You're welcome to link our content to your pages. You know, that worksheet I have that shows the numbers, I'm happy to share that with anybody that wants it. You can create your own. I mean, it's all just generated right off of a Google mortgage calculator. So it's very simple to get that information. But use it on social media. I mean, we all promote ourselves in those spaces. You might as well promote to potential homeowners, hey, did you know you have a special asset? Create educational videos or posts that explain the assumable mortgage process to the public and showcase your expertise. By going through this class, the purpose of this class is to help make you an expert in this space. So showcase that, do videos, do little posts. You're welcome to send them to us. I love to see them. I have seen some agents do some very creative stuff to put out there to the marketplace. Use farming tools to identify properties with assumable loans originated or refinanced in the last few years. Now, the best interest rates were created between March of 2020 and March of 2022. By and large, interest rates created in that time frame, whether refinanced or new loans, are below 3.5%. Like I said, the lowest one we've processed was 1.75%, which I'm guessing was around for like 2 days, but they're out there. So uh, there are companies that can help you farm just for those specific things. Um, Market directly to those homeowners for potential listings. Your title rep can assist you in targeting the right audience frequently if you've got that in your marketplace. Teach classes to homeowners about the value of their assumable loan in a rising rate market. I have attended some classes taught by agents just to be backup for them. So that is something you can put on for potential people. Now, on our website, you're welcome to incorporate our listing presentation flyer. It's something that's just a little one pager that talks about the value of it. You can download it for free. You can throw it into your own listing presentation. All right, target buyers who could benefit from assuming a low rate loan. Now, none of this is that different from the other side, right? Reach out to your past clients or your network who may be the most payment sensitive. You could bring buyers back into the market as affordability becomes more challenging. Specifically, I did this. I had clients who were looking prior to 2022 who, when things started to really change, they pulled themselves out of the marketplace. They just didn't feel like they could live in the payment at the new rate. And so they felt like we're not going to buy. And I was able to sit them down and say, okay, these were VA sellers as well. And I was like, look, you have the potential to go in and assume somebody else's loan and keep the low payment. You've got something out there that can bring you back into the market. So if you've had clients go by the wayside because of the affordability issues, maybe it's time to go back to them and say, hey, look, did you know this exists? Use social media to educate buyers about assumable mortgages. Share real examples of payment savings that can be achieved by assuming an existing loan. Feel free, once again, to use our examples. Now, I think this is where you really master showing those numbers that we had on those slides. If you can show, okay, there's this home and it's got this loan and it's for sale, and this is what it looks like in the payment versus what it would look like in a new loan. Wow, you can really draw potential buyers into the market. Uh, I think collaborate with listing agents to promote listings that have these. Showcase mortgage and payment details to highlight the benefits of lower rate assumable loans, right? If I'm a listing agent and a buyer agent out there wants to promote my listing, I'm sure as heck going to say whatever you want to do. I mean, my goal is to help my seller. So I love agents who want to collaborate with me. So if you don't have the listing, that might be okay. Say, hey, I want to try and promote this, see if I can bring a buyer. Most agents are down for that. Engage with the veteran community. Explain how assuming a VA loan and swapping entitlements with another veteran benefits both parties who've served our nation. Those VA buyers are the most attractive buyer to a seller with a VA. I mean, if they can get their full entitlement release, of course they would prefer it. I mean, I think everybody would prefer it. It's not always possible, but go reach out to the community of veterans and say, hey, you're you're not only available to take advantage of this marketplace, but you're the most attractive person to do it. Host buyer classes about the value of assuming a low rate loan in a rising rate market, and you can use our content. If you were in our local market, we'd co-teach with you, or if we could do it over Zoom, we're happy to do that as well. All right. Now, let's say you get the listing. What do you do from here? So we're going to talk about effectively promote listings with assumable mortgages. This is key to making a marketplace work correctly. For a marketplace to work correctly, the thing that's being sold must be discoverable, right? And so you really have to get the word out there properly. So use MLS fields for assumable mortgages. Enter details like loan type, balance, interest rate, and payment. Uh, I have been asked many times, am I, is it okay to expose an interest rate? This is a fixed thing. This isn't subject to the buyer's credit or, any kind about their situation. You can't go out and market a listing and say, you know, 5% interest rate because that depends on a lot of things in the buyer's profile if they can get that rate. This is something that's fixed. This is something that's not changed. They do have to qualify for it, of course, but it's not dependent on their scenario, their situation. So expose the interest rate, the payment, the loan balance. Do not hide that information. I see agents all the time like playing this secret game with the asset that they're trying to expose. Get it out there. You do not want to hide it at all. So include the monthly payment in remarks that syndicate to public sites, Realtor.com, Zillow. I know how much we all love Zillow, to help buyers visualize the savings. Now, not every MLS has public remarks that upload. So sometimes you got to go in places and manually put that stuff in. But you want to expose, hey, the monthly payment on this house, if you assume this loan, is X. You want to get that where the general public can see it, because if the general public can see it, your odds of double ending a listing actually are going to go way up. We know a lot of agents that are doing both sides of the deal because buyers are hunting these and going directly to the listing agents commonly. Use social media to showcase the listing, emphasizing the lower payment versus similar homes with an assumable mortgage. Many Facebook groups out there can help with property marketing. There are national Facebook groups dedicated to VA and FHA. There are local Facebook groups. If there's not a local one, it might be a great opportunity for you to start. We're members of a lot of these groups, and we see agents posting stuff so people can find what they've got. But we also see in those groups, believe it or not, we see buyers posting wants and needs. So get involved in a lot of those groups. Look them up. They are there. Or start one yourself. Some of the bigger ones have 4, 5, 6, 7,000 members. So they're pretty robust in terms of what's out there. Now, we don't own any of those. I can't tell you about their rules on posting and membership and stuff like that, but they exist. Highlight the assumable mortgage and payment savings with flyers and at open houses. Feature the assumable mortgage on savings on sign riders and boxes, anything you can, anywhere you promote. I think the key here is that you're promoting this asset. Imagine if you didn't promote this, I would equate it to saying, like say you took a listing with a fantastic view or a totally remodeled kitchen or bathrooms, and you didn't say anything about it or you didn't take photos of it. and you didn't put it out there. That's not doing your client a service. Get this out there because this makes them unique in your marketplace. This makes their house more attractive and might, and I say might, command a premium. I mean, I know if I was buying a house and I was saving $1,000 in the month in the payment, it wouldn't bother me at all to pay $12,000 more because I'd make it up in a year. Now, I can't tell you what that value is to your marketplace. It depends on how hot your marketplace is. But remember, you do not need an appraisal. So you can sell it for whatever you want to sell it for if a buyer is willing to pay it. So keep that in mind. You have something valuable as a seller and as a listing agent. Get it out into the marketplace and market it. Now, show buyers and agents that Assumption Solutions will assist with the process to ensure a smooth closing. We see so many agents in the marketplace who are kind of scared of this marketplace because they don't have familiarity with it. They have never done an assumption, they've never been involved in it. So they're kind of scared about advising clients and figuring out how to go through it. And so you can say, hey, look, I have this third party company. They do more assumptions than probably anybody in the nation. We sort of invented this space and they'll basically be our partner to get us through this as smoothly as possible. Now, once again, it's not an easy space. It's not a timelines are always set perfectly type of a space. But keep in mind, it is something that if agents feel like they have help to go through this, they're much more comfortable going through this deal with you as a listing agent. So show them they have a partner. You can direct them to our website. You can direct them to our training videos. They can easily reach me directly. I talk to agents all day about this space. So show that you have a partner to get to a smooth closing. Okay. Now partner with experts to ensure a smooth transaction process. Now, there are great resources on our website, education, videos, all that kind of stuff. That's good for agents, good for potential clients, buyers, and sellers. Matter of fact, I tell agents it's a good idea to give our training video to your client before they go into a deal so they can sit through this, right? And they can see what to expect and what it's going to look like. Now, there's been a lot of other things that have come into this space. And being so early in this space, it's been a very unique experience for us to see and talk to other unique entrepreneurs that have come into this space, from owners of Facebook groups to tech companies. The one I'm going to mention here, I'm a big fan of. We don't own it. We're not affiliated with any way other than they refer what we do out, we refer what they do out. But I think it's a great site. It's called assumelist.com. It's a subscription-based search platform available in major markets with a direct MLS feed. It enables agents and clients to quickly find properties with assumable loans. It displays active homes marketing assumable loans, those that have assumable loans but are not marketing it correctly, and even homes with assumable loans not currently for sale, which we can use as a prospecting tool. So it is very cool. Now, my MLS in Colorado Springs, I can I can build searches for clients for in there. I can hunt for property in there for sure, but it's dependent on agents who have put information correctly into the MLS. The cool thing with this Assume List tool, if it's in your marketplace, and you can reach out to them directly if it's not, because they're always looking to expand. But the cool thing is it somehow, which I'm not a tech guy, will connect recording data with MLS data so that even if a property is not marketed as assumable correctly, but it's got one, you will be able to find it. And so now when I have a potential buyer, I actually build my search in them and it's branded to me. It's got my name and it's a really cool thing. And so, yeah, I'm a big fan of their search site and what they've done there. But what blew my mind was, and a lot of times I will show this site when somebody is trying to gain information about how robust it is in their marketplace. you can go in and you can toggle from active listings on the market to off market. And it will show you all of the assumable loans on a map and in a list that carry a rate, I think, of below 5.5%. And so a lot of marketplaces you go in, you might see 3, 4,000 homes on the market that are actively marketed that are assumable. But then you'll go and you'll click off market and you might see 10,000, 30,000, 100,000 that are off market that carry these rates. Now they even have a thing that you can click on those and you can do a skip trace directly from their site, which will give you, if available, a phone number and email to directly market to potential clients too. So it's a cool site. I pay it yearly. I think it costs me 700 bucks, but they have a monthly option as well. So check them out. Once again, we're a big fan. I talk with the owner of that company frequently. They do a lot of training videos. I think they even have weekly training that they do. So they've got a lot of great resources. All right. It's a tough market, but the best agents always find a way. I love real estate agents because no matter what's going on in the world, what craziness, we're out there trying to help people get to their goals. And we're asking anyone want to buy a house. So that's all I've got for you. We will open it up here for a quick Q&A. I know we're kind of running up against the time limit. So if you've got a Q&A,
There
let me,
are a few questions here in the chat.
let me open up the
Uh,
chat here.
Heather said that she's been told that the original borrower or veteran could somehow still be on the hook if the assumer defaults. Is that true?
It is not true. You are released from liability when the assumption takes place. I will say, though, if you leave the entitlement behind and then the buyer defaults, that entitlement will be permanently affected. But it's not coming against your credit. It's not coming any kind of default judgment or anything like that. It would not be an assumption if you had any tie back to the liability. I will kind of give one caveat, not in VA and FHA assumptions. USDA loans are also considered assumable. We don't touch them, and a lot of servicers don't even get involved in that because I do believe that there is some remaining liability in USDA loans if there's a default. But we're not talking about that space. VA and FHA, there is no remaining liability once the assumption takes place.
Excellent. Does the second also have to be an assumable on a VA loan?
Great question. When we first started going um, into seconds, truth or rumor, I don't know, because once again, this was part of the evolving market. So we saw people starting to say that VA wanted seconds to be assumable if they were going to allow them, and that product did not exist anywhere. Then it kind of came out that was really just rumor. So no, the seconds are not assumable. They are just a straight attached to the property type of a loan.
Okay, okay. So any company that does, any lender that does second mortgages could conceivably lend on this. It doesn't have to be
Yeah,
that.
we have found that there's very few companies that do seconds. The one that we see most commonly that we kind of refer to is Barrett Financial, but there are others out there, I'm sure. So check with your local marketplace and see what you've got. If you don't have anything, reach out to us. We'll give you the people that we know that are in that space.
And then didn't the VA have a rule that they made a rule that the assumption has to be approved within 45 calendar days?
So that's nothing new. There's always been a guideline that there is a 45-day process for assumptions. Almost none of them are meeting it. Right. They issued a circular or reissued a circular saying, hey, this is what it's supposed to take. Because when we started, believe it or not, if you got it done in less than 120 days in 2022, you were pretty lucky. We see not that many deals go beyond 90 anymore. If a servicer is really backed up or if there's a lot of complications in the deal, it can happen. So once again, remain flexible. But until there's teeth, until there's a bite that enforces that rule, yeah, servicers are finding a way around it. And there's even some nuance to that rule in terms of it's supposed to be from a completed, submitted file. Well,
Correct.
there's a lot of things they kind of can do to say, well, we don't have a complete file. And so, once again, that's just another reason I think to have our team, which I'll be honest, I don't touch a single file. My processing team is made up of multi-decade lenders who at this point have touched more assumptions than anybody else, right? That's why we're so heavily involved upfront to make sure that all those I's are dotted and T's are crossed because we don't want them using their excuses to say, oh, well, we don't have X, so we can't go forward, right? You don't have a completed file. And so our goal is to keep you out of those tricks and traps.
So the earlier we get, so we should get you involved as soon as we get the listing agreement signed so that you can do all the work ahead of
There's
time.
no, they won't do anything with you until you have a buyer. So there's nothing to do, there's no role for us until you have that contract together.
Okay.
When you have that contract together, I say like the same day, send it to us. Right, the same day, because when we can build our file, once we build our file, we're going to send out welcome emails. We're going to send out a list of requirements and expectations that we need, that buyers are going to get, and the clients are going to get access to our secure portal to upload things directly to us. Um, this the there's a about the only thing I would say you may be able to get in advance of going under contract is you could reach out to your servicer and try to get an assumption packet. But truthfully, we have most of those. That doesn't mean they don't get updated and get changed, but even then, they may not send it to you until you have a deal in place because they're
Okay.
focused on files that are active and they only have so much staff too. So,
Yes, that
yeah,
is why I thought that maybe
yeah.
getting it done sooner rather than later. So are there any lenders that you can say are easier than others?
Oh, for sure. I'm not going to blast anybody on a video that I'll probably put on our website, but check with us. Yes, there are.
Well, you can tell us the easy ones. You don't have to tell us
Sure.
the
Okay.
difficult
Sure.
ones, but you can
Well,
tell us the easy ones.
easy-ish. They're all at times, even the ones that I would maybe put are pretty good. Like we've had a lot of good track record with Penny Mac, but then Penny Mac, they're so big, they started getting so much volume that it was they just bogged down, truthfully, right? I mean, we've talked to servicers who have said to us directly, we have 4,000 active files, right? And
Wow.
yeah, so there are servicers who at the get-go were very difficult to work with who've gotten better. There are servicers who've gotten worse because they were sold or they got bought. Or we had one servicer that was pretty good, and then they decided they wanted to outsource the processing to a third party, and that third party was junk. And so, you know, that's why, once again, I always say remain flexible because you don't know what's changing on their side. Even if we've done 50 deals with that servicer in the last 3 months, then they make a change or they fire a bunch of people or something crazy happens. You never know. But yeah, I would tell you in a non-recorded setting who we like and who we don't like.
Well, you can end the recording and then tell us. So there's one other question here. Is it easy for a surviving spouse of a veteran to assume his VA loan?
I'm not sure there's a reason.
I don't
Uh,
know either.
yeah, I mean, uh, when you're I've seen it happen.
I guess if
Um,
they were not on title, if
oh,
the
oh,
veteran bought the property before they got married and they were not on the loan, maybe, or on title, maybe.
yeah, I think that's easier than, believe it or not, we've seen some trouble with estates trying to sell a property and allow a loan to be assumed in situation where it goes veteran to non-veteran because it's kind of up in the air as to whether, they want to allow a deceased person's entitlement to transfer. It's a case
Okay.
by case scenario there. And that one, I might say I'd have to talk to the person specifically, and I might even link them up with my processing team, who's a little bit more entrenched in some of those deeper deal nuances than I am because they touch them every day.
Gotcha. Gotcha. Well, I know I learned stuff. Like I never thought about having somebody think about the fact that it might not be the lowest interest rate, but the years of interest that were already paid. Never thought of that. So I appreciate you doing this for us today. I guess we will try and have you on again early next year for the people that missed it. But we will, everyone, he's recorded this. He's going to share that with us. We will send the recording out to you with a little update on what the little recap of what this was. I appreciate everyone who joined us today. I hope you feel a lot more confident in being able to talk about VA and FHA. And if not, please give Craig a call.
Yeah, you can reach us very easily through our website, assumptionsolutions.com. Contact us, emails goes directly to me. Voicemails go directly to me. We're here to be a resource and help you with anything you've got. So we
Thank you,
welcome any
Craig.
and all questions.
I appreciate it. Appreciate your time. Thank you.
You got it. Thank
Bye,
you.
everybody.